welcome to NDTV Profit. I'm Niraj Shah and you're watching The Talking Point. Joining me today on the show is Aditya Khemka, Fund Manager at InCred Asset Management. The case for a chat today, obviously around healthcare. Aditya specializes in that. And we thought we'll pick up different facets of healthcare to try and understand what is it that we should be talking to him. So let's get the case for a chat. First up, on your screen, pharma opportunity, will it lie in the small and mid caps? Or will it stick with the large caps, as is the case in some of the other sectors? Can diagnostics come of age and even go and outperform hospitals? Or is that even a consideration while investing into these stocks? We'll ask Aditya because he's been constructive on diagnostic companies for some time. And is the CDMO space at a turning point? I think that is the other key thing that we need to probe with Aditya today. Aditya, great having you as always. Thanks for taking the time out. I hope all is well.
All is well, Niraj. Thanks for having me.
The pleasure is entirely ours. Aditya, the earnings season has seen some of the companies or most of the companies come out. We've seen diagnostic players, CDMO players, even pure play pharma companies come out. It's the quarter and it's the year gone by. What has stood out for you?
So what has stood out are two things, Niraj. Number one, the large cap pharma companies or the unbranded generic companies, they have done fairly well compared to our expectations. I think they have done better than what we had expected. And that doesn't seem to be driven by the broader market rally because we still don't see enough evidence to infer that the broader unbranded generic market fundamentals are improving. But yeah, there are product-specific opportunities which are playing out well for the unbranded guys. So that has been something that has outperformed our expectations. On the other side, we have seen hospitals underperforming expectations, and we have been saying that the valuations of hospitals are probably run far behind, what was fairly intrinsic value. And hence, now that the hospital's earnings momentum is slowing down or normalizing, I think hospital stocks seem like a difficult trade at this point. And lastly, diagnostics have done phenomenally well. The top line growth has been far beyond our expectations. Margins have been a little, I should say, subdued, but I think that's mostly driven by the need for capacity expansion or the need for geographical footprint expansion. And hence, that has depressed margins for diagnostics. But I think that, as always, is temporary because once the expansion starts bearing revenue, you will see the margins expanding to normal again.
Okay. Can I start off with the larger one first, Aditya? Because I've learned it from you that you try and think of some of those US exposed multinationals, Indian multinationals, as FMCG players and play a cycle. Now, I would love to understand from you, where in the cycle are we? Is Revlimid strong enough for this cycle to continue? When does the market start discounting the end of the Revlimid revenues, and do the companies do something else by then?
Sure. So I think Revlimid, all of us know, it's a known fact that in 2026, the product goes off, the patent goes off, and there will be stiff competition, price erosion. And, these companies which are making $200, $300 million on that product today, that number will fall to, I don't know, 10, 20, $30 million. So, and it will become like any other product opportunity in the past. So I think that's clearly, there's clearly a deadline after which Revlimid is not going to help earnings. In fact, it will hurt earnings because it is currently a large part of your earnings, and then it will go down to virtually zero or any insignificant number, right? So when does the market start discounting that? It's a puzzle that, it's anybody's guess. Market should have already discounted it, if you ask me, because we always look 1 year forward in terms of price targets and hence 2 year forward in terms of earnings. And 2 years forward, Revlimid will have no impact on the earnings that you project for these companies, and hence market should have already started discounting that. But I think there's also an element of momentum of the market, right? So if the market is in momentum, stock prices are flaring, then these things take a backseat. The fundamentals take a backseat. It's more about PE multiples and what cash flow you can generate this year and visibility for the next 2 quarters. I think those things take more of a front seat in a situation like this. So no doubt, the unbranded pharma companies will have a tough time 2 years down the road, for sure, in displaying any growth in earnings. When the market starts discounting that, I think your guess is as good as mine. It's just a matter of perspective there.
Now, I'm certain that your perspective is much more informed than mine, Aditya. So hence the need to ask this to you. Okay, I'll stick to pharma first. We'll do healthcare or the broader healthcare in the next segment. But pharmaceuticals, CDMO players, the other aspect. You would have guessed that I would ask you about it because Aditya, the commentary seemed, how do I say, constructive, mixed constructive, if you will, because players are talking about the possibility of R&D spends coming back, contract sizes becoming good, but back-ended, maybe in the second half. And we've heard the possibility of this now for a while. Are you baking in positives here for CDMO players, or is there still some time before you start becoming constructive?
So, Niraj, unfortunately, I think the response to this question is very company specific. Something like a Syngene or a Newland may have a tough FY25 because they had a great FY24. So, see, the CDMO business, especially when you deal with innovators, it tends to be lumpy. Now, the lumpiness is not just within quarters, sometimes it's within years also. So, an innovator might give you a project which you finished in year one, and he may not give you another project till year three. So, in which case, your year two over year one will not look like a good year, because you did a project in year one, which is not recurring in year two. Similarly, let's say if you're contract manufacturing innovator's product, he just might buy enough inventory for 2 years in 2 quarters. And then for the next 1.5 years, you don't have any orders for the same product from the same innovator. And hence, your again, year two will look difficult compared to year one, because you have recognized all the revenue in year one, and year two will not have much of revenue from that product. So, when they invest in CDMOs for innovators, needs to be cognizant that this is a business that if it is not very broad-based, if it is not broad-based across several clients and several projects, which just today isn't the case in many of these, CDMO companies in India, given that their scale is really small. Compared to global innovators, if you look at WuXi, Lonza, Catalent, Recipharm, compare these companies' revenue, they are like 1/5, 1/6, 1/8 of the revenue these giants do, with whom they are competing in the marketplace. So, yes, you have to be prepared for lumpiness. The lumpiness can be within quarters, can be within years. But if you take a 5-year view, which is generally how we operate with a 5-year view of, where the stock or where the earnings would be in 5 years, then these lumpinesses doesn't bother you. In fact, every dip gives you an opportunity to add, and, so that you can build a sizable position by the end of the 5th year. And I think that is where things look really, really good for the CDMOs based out of India. But yes, FY25 would be difficult for companies like Syngene or Newland. They can be really good for companies like Heikel, for whom FY24 was not a good year. So again, which is why I said it is a company specific. It's not gonna be a routine thing for everybody. FY24 for Newland was a great year, but FY24 for Heikel, despite Heikel also being a CDMO player, it wasn't great. So you have to look at it from a individual business standpoint and not really from a CDMO sector standpoint.
Aditya, I'll just extend that conversation by a little bit. Just wanted to understand. So for a lot of players who are talking about how some of their capacities are coming on stream over the course of the next 2 years, how does one view them in the CDMO space? Because, I mean, I'm just taking a case in point because that's a management I talk to often. Let's say Lotus. I'm not asking you to recommend a buy or a sell on that stock. Just trying to understand this, because I heard you say that CDMO could be lumpy, but after a point of time, with capacities on stream and contracts on stream, there could be a linearity to growth, maybe. How do you view those players for which capacities are coming on stream steadily over the next 24 months?
Right. So here again, I'll give you 2 examples. And again, these are not buy-sell recommendations, but just what we have observed over the past 2-3 years. Divi's Labs a couple of years back announced huge capex plans, and they had huge CDMO capacity that they had built. They just didn't get the orders, right? So post Paxlovid, I think their ability to get more contracts on the CDMO side just sort of flattened out. And they are now, now the capacity is on stream, but they are waiting and they are hunting for customer orders. And on the other hand, you had a Newland, which built capacity once they had the orders, which could justify the capacity. So, it's totally dependent on the management of the company. Some of these companies, work on the basis that there is a Biosecure Act in place in US, and hence customers will look for alternatives, and hence I should prepare the capacity and be prepared for customers who come with inquiries to me. On the other hand, some of the players take a route where they say, let the customer come to me, give me an inquiry, let him confirm an order, and that's when I start building the capacity. I tell him that there will be a 6-month, 1-year lag between the placement of the order and the execution of the order, and in that time I will sort of put the capacity in place and execute his order. So It's again something that is completely dependent on the company. To my understanding, Laurus seems to be a company where they are installing capacity, and they are pretty confident that they will get orders. But I don't think they have orders in hand for the capacity that they are installing, and that's more of the DV's approach and less of the Newland approach, if you ask me. But that's the way they are operating. There's no good or bad here, because over 4 or 5 years, given how the global CDMO landscape is evolving, all of them will get orders. There's going to be too much business for anyone to miss out on it. But yeah, in between, guys who build capacities but don't have orders to execute on that capacity will show some lumpiness in operating margins and all that, and that again investors will have to bear, because you are taking a 4 or 5 year call when you're investing in CDMO. It's not really a 1 year or a 2 quarter call.
That's such a fabulous explanation, Aditya. Thanks. And no, for an equity investor, it's important. No, a company may be great, but it may not be the best investment at the current point of time, because there might be lumpiness ahead. And Aditya, thanks for that. That is really well explained. The other aspect, Aditya, is diagnostics, right? You've remained constructive. The stocks now have started to do well, not just in terms of stock price performance, but I thought even the earnings display by some of them was pretty resilient, if you will, and the COVID base, or the Paxlovid base, or what the COVID base, sorry, is now out of the way, right? I mean, 2024 was FY24 was largely without that. What's your sense? Most people pencil 8, 9, 10% kind of CAGR growth, coupled with multiple things adding to that. What is your sense about diagnostics now?
So again, no sector level point here, because diagnostics sector might grow at 10%, let's say, CAGR over the next 4 or 5 years. But you would have companies like Krishna. They had their con call yesterday. They said 25 to 30% top line CAGR over the next 3 to 5 years. That's also because they're sitting on a very small base, and they are in a space where there is very limited competition, and the TAM is probably 10, 12 times the existing TAM. Right, so there's a huge target action market, is far higher than what you have currently in the space. So they talked about all those things. So they might grow at 25-30% if you were to believe management commentary over the next 4 or 5 years. Something like a Thyrocare, they spoke of mid-teen earnings, mid-teen top line growth over the next 4 or 5 years, because they have expanded their pin codes from 4,000 to some 8,000 pin codes. They have expanded number of franchises from 3,000 to 9,000 or 8,500. And these new franchises will give them business over the next 4 or 5 years. So they will probably grow much higher than the market. On the other hand, you had a Dr. Lal or a Metropolis, for whom probably without inorganic, to grow faster than the market may be difficult given the size at which they're sitting. Right. So I would say, if you are to talk about diagnostic as a sector, yes, 10% growth is something one should be comfortable with. But if you were to talk about individual stories, you will have huge digressions in growth within individual businesses within diagnostics.
Point well noted. Okay. Aditya, do you believe in the possibility of some of these businesses being able to grow at 25-30%? Is the market conducive enough for that to happen?
So if you look at history, right, so particularly in case of Krishna, because Krishna is the company which is talking about 25-30% growth. If you look at their history, they've grown at 35% CAGR top line. Obviously, they were much smaller, historically speaking. The starting point was much smaller than today's revenue. But in Krishna, what you get is you get some visibility, unlike, a Metropolis or a Dr. Lal or even a Thyrocare, where, you have to believe that if they have open stores, they'll be able to kind of monetize the stores, or they'll be able to monetize the franchisees. That's an assumption that we make. In Krishna, the visibility is slightly higher because they have tenders which is in the public domain. So if they won the tenders, and if the tender size is in public domain, in which market the tender is, that is in public domain, what pricing they have won the tender is in public domain. So if you just build out revenues as per the tenders that they have won, and they will probably execute over the next 2-3 years. So we have data enough to justify next 2 to 3 years of 30-35% or 25-30% growth in Krishna Diagnostics. But again, that's the visibility we have for the next 2-3 years. Beyond that, they will need to win more tenders to justify growth of 25-30% beyond next 2-3 years. So which obviously is an ongoing process. And B2G in diagnostics is a very, very nascent business. But what we have observed is that every government, when they renew the contract with a company like Krishna, they increase the size of the contract by 2-3x. So Rajasthan contract, when it expired in August 22, was a 70 crore per annum contract. And the new contract, which they have been, in the process of awarding, that contract can be a 300 crore contract from the same state. So 70 crore per annum revenue to 300 crore per annum revenue. That will happen, from the same contract. So
Got
the
it.
point
Got
here
it.
is that the TAM is far bigger than what is currently represented by the revenues.
Got it. Aditya, one final question, and that's on hospitals. I mean, the belief is that the hospital segment has undergone capex already, and now they are in the execution phase, and hopefully earnings momentum will be very strong. Branded hospitals might work well. We spoke to a couple of other guests who were of that belief too. Are you constructive here? Why or why not?
So hospitals, I think earnings momentum is undoubtable. I think India was a market where, the number of hospital beds that we deserve or we need is far higher than the number of beds we have. So there was clearly a supply demand gap in the segment. I think all this greenfield, brownfield expansion done by different hospital chains is addressing that gap. So I don't think earnings momentum is under question in a significant way. Again, it can be different from individual stock standpoint, but at a sectoral level, I don't think there is any challenge in terms of earnings momentum. I think what investors need to be very and cognizant of is at what price do you buy that story, right? So if you buy a hospital at 5 times free cash flow yield, and the hospital is growing at 10% top line, 15% bottom line, that's a great investment. But if you're buying a hospital at 1.5% free cash flow yield, and the growth is similar, 10% top line, 15% bottom line, you're probably not going to make money for a while. So the entry point matters, and the entry point decides the returns that you make over the next 3 to 5 years. So I would say one needs to be cautious on the hospital space in terms of entry point today. I think some of these stories have run far beyond their intrinsic values.
Okay. Wow, it's great to get this perspectives from you, Aditya, as always. Thank you so much for taking the time out and being with us on the show. Really appreciate your time. And yep, see you soon. Hopefully in person in our studios.
Thanks, Niraj. Sure.
Right. That's the view from Aditya Khemka, fund manager at InCred Asset Management on healthcare. Arguably one of the best voices out there in the street currently. And viewers, thanks for tuning into this edition of The Talking Point.